Want to be greedy when others are really fearful? Looking for a 5% plus yield backed by a double-digit dividend growth rate? Interested in getting a great deal on a great stock after it's fallen by nearly 40%? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is one of the largest banks in the United States. When someone says that they make bank, what do they mean by that? Well, they're trying to say that they make a lot of money. The word bank is strongly associated with the word money. Why is that? Well, that's because banks are in the business of money. And being in the business of money is what helps this company to make bank and pay a large increasing dividend. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of US Bancorp, which appear to be trading at a significant discount today. US Bancorp, stock ticker USB, is a bank holding company that offers a diversified mix of financial services, including traditional retail banking, wealth management, commercial banking, and payment services. Founded in 1863, US Bancorp is now a $50 billion by market cap banking behemoth that employs 76,000 people. Operating as the fifth largest American bank by deposits, US Bancorp has over 2,000 branches spread out across 26 different states, primarily in the Midwest and West. The bank ranks first in deposit share in 4 states, while it has a top 5 position in 17 states. The company reports results across 5 business segments: consumer and business banking, 35% of fiscal year 2022 revenue, payment services, 26%, corporate and commercial banking, 18%, wealth management and investment services, 17%, and treasury and corporate support, 4%. There are so many reasons to love the banking business model. When someone says they make bank, it means they're making a lot of money. The word bank has come to be strongly associated with money. That's because banks are literally in the business of money. And if one wants to make money, money itself is a pretty good place to start. But it's not just money, it's other people's money. Banks take in deposits from depositors. Deposits become a float, a low cost and low risk source of capital that allows a bank to fund loans and other ventures in order to earn a return. It's been said that you need money to make money. Well, banks take that pretty seriously by gathering lots of money in order to make lots of money. This is an idea that is timeless. Banks have been around for thousands of years. You can trace banking back to antiquity. Why is the business model so enduring? It comes down to commerce and the flow of money, goods, and services. Without the financial framework that banking allows for, our way of life collapses and we go back to a bartering existence. Here's how Morningstar describes US Bancorp, and I quote, US Bancorp is the largest non-GSIB in the US and has been one of the most profitable regional banks we cover. Few domestic competitors can match its operating efficiency and returns on equity over the past 15 years. Unquote. Good stuff. Because US Bancorp runs such a powerful, necessary, and enduring business model, the company is positioned to continue increasing its revenue, profit, and dividend for many more years to come. The company has increased its dividend for 12 consecutive years. The 10-year dividend growth rate of 10.1% is quite strong. What's really notable here is the fact that you're pairing that with the stock starting yield of 5.1%. If you think that kind of yield is unusually high for a large, stable bank, You're right. This market smashing yield is 180 basis points higher than its own 5-year average. And with the payout ratio sitting at 52%, this is not an unsafe dividend. The yield is so high not because of specific dividend danger, but because of a temporary panic across the general banking industry, which I'll delve into later. It's very rare that a bank will offer a yield that's competitive with high yield instruments such as REITs, but that's the kind of opportunity we could have on our hands right now. For dividend growth investors who like to be greedy when others are fearful, these dividend metrics are quite enticing. Looking at business growth, US Bancorp enlarged its revenue from $19.6 billion in fiscal year 2013 to $24.3 billion in fiscal year 2022. That's a compound annual growth rate of 2.4%. So top line growth here. It's been a very challenging decade for banks with heightened regulation, low interest rates, and a floundering economy, all conspiring to limit growth across the industry. We then threw a global pandemic in there for good measure. This is about as bad as it gets for banks. In my view, even modest expansion in the business is comforting. Meanwhile, earnings per share grew from $3 to $4.45 adjusted over this period, which is a compound annual growth rate of 4.5%. I used adjusted EPS for fiscal year 2022 in order to factor out unusual expenses related to the company's recent acquisition of MUFG Union Bank, which was completed in December 2022. I should note that regular share repurchases did help to drive excess bottom line growth. The outstanding share count is down by 19% over this period. Again, not super inspiring growth like I already pointed out. It's been a tough decade and recent events aren't making things any better. That said, it's ultimately where a business is going, not where it's been, that matters most to the investors of today. Looking forward, CFRA believes that US Bancorp will grow its earnings per share at a compound annual growth rate of 7% over the next 3 years. This forecast hinges quite a bit on the company's recent acquisition, coinciding perfectly with a normalizing / improving post-pandemic environment. Regarding the acquisition, CFRA states, and I quote, on December 1st, 2022, US Bancorp closed its acquisition of Union Bank and added 1 million consumer accounts, 190,000 business clients, 50,000 affluent households, and 280 new branches in California, unquote. The acquisition of MUFG Union Bank didn't close until fiscal year 2022 is almost over, so we haven't really had a chance to see how much this can positively impact the combined enterprise. But it does shape US Bancorp in a positive way, and CFRA is enthusiastic about the tie-up. Again, and I quote, we continue to be impressed with US Bancorp's digital transformation and are excited by its increased West Coast presence. Additionally, we expect improving bank efficiency over the next few years as US Bancorp benefits from cost synergies stemming from the Union Bank acquisition, unquote. US Bancorp is guiding for adjusted total revenue of $29 billion to $31 billion for fiscal year 2023, which would represent a substantial move up from what was reported for fiscal year 2022. I think it's important to take notice of 2 points here. First, it goes without saying that higher interest rates benefit US Bancorp in terms of net interest margin. Second, about half of the business has a steady fee-based framework. I concur with CFRA's overall enthusiasm. With that positivity out of the way, let's delve into some negativity. Unless you're living under a rock, you'll know that bank stocks have been absolutely rocked over the last few weeks. A few bank failures caused widespread panic among the investing community, with many believing that contagion and bank runs across the board would result in a cascading domino effect across almost all banking institutions. However, it's important to point out what actually happened here. A few banks failed, yes, but those failures can be largely pinned down to idiosyncratic issues, including but not limited to concentrated depositors, cryptocurrency exposure, poor risk management, and a large percentage of uninsured deposits. That last point is especially germane. One of the banks that failed, Silicon Valley Bank, had an extremely high ratio of uninsured deposits to total deposits, approximately 90%. This resulted in a fear of potential losses among depositors, which then led to a bank run. US Bancorp's ratio is closer to 50% on this point. Furthermore, Silicon Valley Bank had a depositor base that was very concentrated around the venture capital community, and this concentrated depositor base exacerbated the velocity and intensity of the bank run. US Bancorp has a far more granular and quote-unquote regular depositor base. There are many reasons why US Bancorp has nothing to do with what happened to Silicon Valley Bank. In addition, it's quite possible that some banks' pain will end up being US Bancorp's gain. To the extent that a deposit flight has occurred, which appears to be relatively muted and mostly overblown, this capital has seemingly flowed upward with a bank's size otherwise benefiting larger financial institutions like US Bancorp. Overall, I think US Bancorp is one of America's best banks. It's definitely one of the biggest. On the other hand, it's quite possible, even likely, that banks across the board will see higher fees and more regulation in the aftermath of recent bank failures, which slightly reduces the long-term profitability outlook. Getting back to the forecast, a 7% compound annual growth rate in earnings per share would allow for a similar rate of dividend growth. While dividend raises may be conservative in the near term, if only to account for the uncertainty across the industry, you're already starting off with a 5% plus yield. I don't think you need high single-digit dividend growth to make sense of an investment here, but the fact that this kind of dividend growth could transpire on top of a 5% plus yield makes this a particularly compelling long-term investment idea right now. Moving over to the balance sheet, US Bancorp has a great financial position. Total assets of $675 billion line up well against $624 billion in total liabilities. Their senior unsecured debt has the following credit ratings: A2 Moody's, A+ S&P, A+ Fitch. These ratings are well into investment grade territory. Profitability for the bank is outstanding. Over the last 5 years, the firm's average annual net margin of 27.7% and annual return on equity of 13.9%. Net interest margin came in at 2.7% last year. The banking industry is experiencing turmoil, but US Bancorp is running a steady, stodgy financial institution. And with economies of scale, sticky deposits, switching costs, established relationships, and an entrenched float, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. I see increased regulation stemming from the fallout of recent bank failures. However, bank failures and possible consolidation across the industry eliminates some competition. As we've been reminded of recently, any bank is vulnerable to a sudden bank run. Banks are highly exposed to economic cycles. A recession could hurt the bank through reduced deposits and loan demand on the income statement, as well as higher credit losses on the balance sheet. Interest rates have been persistently low over the last decade, which has put a lid on what banks can do, but rates are finally on the rise. The acquisition of MUFG Union Bank adds near-term questions around execution and capital use. I'd argue that these are pretty customary risks for a bank, but the valuation is currently anything but customary. With the stock down 40% from its recent high, the valuation looks as attractive as I've ever seen it. The price-earnings ratio is 7.8. That's using adjusted earnings per share to factor out the one-time acquisition impact. This is absurdly low for one of the biggest and best financial institutions in the United States. Now, to be fair, banks never really command very high multiples, but the 5-year average PE ratio for this stock is 12.4. We're not even close to that. Another way to look at it is the price-to-book ratio, which is currently 1.2. Banks typically command price-to-book ratios that are between 1 and 2, depending on the growth and quality of the bank. This bank's 5-year average price-to-book ratio is 1.7, which expresses its quality. Again, we're not even close to that level right now. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 6.5%. That dividend growth rate is actually on the low end of what I ordinarily allow for when valuing a bank. It's lower than the 7% mark I used the last time I looked at US Bancorp, and I've dialed expectations back just a bit in order to account for the general turmoil and uncertainty across banking. This mark looks awfully conservative when you weigh it up against the demonstrated dividend growth over the last decade, and I'm also a bit below where CFRA sees earnings per share growth coming in at over the next few years. But I really would rather err on the side of caution here, especially because so many moving parts that are impossible to fully appreciate are currently in place. In the fullness of time, we'll see how all of this plays out, but I think US Bancorp could easily meet or even exceed this kind of dividend growth target. The dividend discount model analysis gives me a fair value of $58.42. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates USB as a 5-star stock with a fair value estimate of $58. CFRA rates USB as a 3-star hold with a 12-month target price of $50. I came out within pennies of where Morningstar is at. Averaging the three numbers out gives us a final valuation of $55.47, which would indicate the stock is possibly 37% undervalued. Here's the bottom line, guys. US Bancorp is one of the biggest and best banks in the United States. While there's undoubtedly a lot of turmoil occurring around it, the makeup of the institution, including a strong focus on fee-based offerings, creates a rock in the storm. With a market-smashing yield, a balanced payout ratio, a double-digit long-term dividend growth rate, more than 10 consecutive years of dividend increases, and the potential that shares are 37% undervalued, this looks like a textbook opportunity for long-term dividend growth investors to be greedy while others are fearful. And now for a special news announcement. It's been reported that Bank of America Corp, stock ticker BAC, has received more than $15 billion in new deposits in the days following the collapse of 3 regional US banks. Money has to go somewhere, and if there's any confidence lost in smaller institutions, the larger banks will almost surely benefit from capital flowing upward with size. We recently analyzed and valued Bank of America, estimating fair value at nearly $40 a share. Warren Buffett has invested heavily into Bank of America. You may want to consider joining the Oracle of Omaha on this one. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.